Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. It's July the 8th. And you know who we are. We don't know who you are, but we really appreciate that you listen to our podcast, and our podcast is growing. Ernest, how are things going today?
Like with me personally?
Yeah,
or the
I don't
markets?
know. The markets, you, what's new?
Like the kids are in camp.
Yeah.
We went camping on the weekend.
Camping. Oh, wow.
Yeah, so camping is one of those things where, I don't know, I feel like it's fun for like 2 days, but then beyond that, you start to get a little sick of it.
Yeah, I wouldn't go camping for more than one night. I don't like to go camping. I was off for a week, just hanging out at the cottage, playing some golf, sitting by the dock, reading some books. It was an excellent week. The weather was really, really good. So here we are back at the podcast desk. Ernest, we're going to do a few more podcasts in July and then take a quick little hiatus for part of end of July and August, and then back to work full time on the podcast.
Sounds good.
So today we're going to talk a bit about what's gone on for the first 6 months. So we'll call it a 6-month review of 2025, talk about the highlights and the lowlights of the market. And then we'll talk about a long-term investment for our portfolio. It's a stock that I say we because I also have held it too for well over 20 years. It's a Canadian bank, and it's been a strong performer. And we'll give our reasons why we think a Canadian bank makes sense in our clients' portfolios. But before that, let's get into this. If you like this podcast, please subscribe to us on YouTube, on Apple, on Spotify. Please give us 5-star reviews. Please leave comments. We really appreciate all your feedback. And of course, if you have any needs for financial services, wealth management, Baskin Wealth would love to meet with you and connect with you. Please visit our website to find out more information about Baskin Wealth and what we have to offer. Ernest, so the first 6 months of the year, I guess you can describe them as choppy, to say the least. I forget already what happened in April, but that was a pretty nasty pullback in the markets after the euphoria of the Trump winning the election again. The markets really rallied, I think, to November or December of 2024 to all-time highs, then pulled back. Looks like money kind of flowed to other products, whether it's gold, whether it's Bitcoin, whether it's international or European stocks. But then the S&P 500 in the last few weeks has reached an all-time high again. So has the NASDAQ. So markets are coming back. I wouldn't say they're overly frothy, so to speak, but there are pockets, of course, of some craziness like 2021. We remember in 2021 when people were buying these NFTs, these non-fungible tokens for millions and millions of dollars, and that turned out to be pretty dumb. So, you know, when the FOMO starts, the YOLO starts, people do kind of lose their minds and don't focus on valuation. They just focus on, I'm going to miss out and I need to get a piece of this. So your takes on before we get to specifics about our portfolio, Ernest, your take on the first 6 months of the year?
Yeah, I think you mentioned that April there was the whole thing about the tariffs, and that really does feel like a different era in the past because of how quickly the news moves on almost on a daily basis.
Yeah.
Like just as we were walking in here, I think Trump was on TV saying that he was going to put a 50% tariff on copper.
That makes no sense to me. But does the U.S. produce any copper?
And then I think it was just 2 weeks ago where it seemed like there was going to be a war between Israel and Iran.
And U.S. getting involved as well.
Right.
Yeah.
and that seems to, I don't really follow it that closely, but that seems to have been like faded away from the headlines a little bit.
I think
So
the big worry for the first part of the year was really that these tariffs would cause big inflation again.
yeah.
We're already 6 months into it. I don't know how the tariffs have really impacted a lot of businesses, but doesn't seem to be that much inflation as a result yet.
Well, I mean, you have to keep in mind that they never actually went into place,
Yeah.
right?
Oh, that's right. They've been paused.
Yeah. So I think what we
Yeah.
did see was that there was a lot of distortions kind of in the inventory and the shipping levels for companies trying to prepare for this kind of prepare for the eventuality of tariffs, especially with a company like Apple, where they were trying to figure out the manufacturing of their products, like shifting production from China to India to Vietnam
Yeah.
to minimize the impact of the tariffs, only to find out that maybe they didn't need to have done all of that to begin with. And so I think it's been certainly been an interesting time, to say the least, not just from a stock perspective, but also for everybody who's managing a company.
Oh, totally, totally. And I feel for people who suffer through the volatility. It's no fun, and it's not it's a feature of the markets. This is not something that we shouldn't expect. We should expect lots of volatility and then times of calm. And just because markets are volatile doesn't mean you need to react or do things to your portfolio. In fact, you should probably use it as an opportunity to buy stocks that you really, really like for the long term that are down, or add to more, or maybe sell something that is lesser quality to buy something that's higher quality, especially if the differentials make sense. So that's kind of where we are in terms of the first 6 months. For our clients, probably a flattish to slightly up type result. Bonds have been okay. Our stocks have been okay. The Canadian dollar has strengthened against the US dollar. That impacts us a bit. Things we missed out on, of course, that have really rocking and rolling this year are maybe gold and some international names. I think like the Polish stock market is up 50%.
Germany defense stock.
Yeah, exactly. So there's going to always be a crazy bull market somewhere. We've seen the recovery of what, I will use a nice term of crapco companies that maybe are not profitable, but have an interesting business plan. Some of their stocks have gone to nosebleed levels, where you've seen some pretty decent values in very profitable names. Like an Adobe or an Apple, or, so pullback in some of those kind of stocks that we will get into today. And you've seen some companies, some of the quality names trade at higher valuations than they have. So it's kind of a mixed bag. But the expectation for this year, Ernest, is strong growth for S&P 500 companies. And even with the tariffs and the threat of the tariffs, whether they're going to kick in or not, you've seen most people expect interest rates in the U.S. to start to come down. Federal Reserve will be cutting interest rates, so that's the expectation, as long as inflation doesn't pick up from here. And the economy has been pretty resilient. I guess that's the best word you can use to describe the North American economy in such a. It's not like things are bad, but there's just a lot of uncertainty, and even if you're a CEO of a big company, you don't even know what to do, what tariff rates are going to be applied, when they're going to be applied, how impactful it's going to be. Should you do something now or wait? Hard to know.
I do think that, kind of looking past all of those things, if you own a good business, it kind of the definition of a good business is that you're a little more protected from the volatility that comes along the way. Where if you have a business that, so I'm going to name CN Rail.
Okay.
I think CN Rail is a fine business, and we owned it in the past.
It's just a good business that's operates in a duopoly in Canada and has strong returns on invested capital. Pretty decent business, pricing power, but the stock has gone nowhere for 4 or 5 years.
No, I want to use CN Rail as an example because it's a pretty good business, but one of the things that I at least failed to recognize, or one of the things that I realized while owning the stock was how volatile the results actually were. Where like this quarter there would be a snowstorm and then they would lose like 10% of their intermodal freight. Then the next quarter there might be a labor strike, and then
There's a lot of labor strikes,
right,
but yeah.
and then another quarter there might be something else, right? And so over time, like they keep talking about, like in a normal period of time, this is what we're going to earn. But then what you eventually realize is that that normal time that they're talking about is kind of like the best of times that almost never happens. So it makes you kind of wonder, like, do you actually have an awesome business? Because if you have an awesome business, then things are going to be doing pretty well, regardless of what's going on. So take Microsoft's like Office 365, for instance. It's just basically a straight line going up, right?
Yeah.
And Office 365 demand, I think, is, no less sensitive to regular economic fluctuations than CN Rail would be. But it's asset light, it's a software recurring subscription business. And I think people are just, it doesn't really have a cost structure to it. It's not impacted by the weather. And to me, that is kind of the hallmarks of what a good business is.
Yeah. But there's, for CN Rail's point, of course, it trades at 18 to 20
Right.
times earnings, and Microsoft trades at 35 to 40 times earnings, right? So
Yes.
you could say that the market is pricing in the fact that CN's business is more cyclical,
Right.
whereas Microsoft's business is more recurring, right?
Exactly.
So you get what you pay for in terms of the market. And of course, the big risk with Microsoft is you find out it can get disrupted or its business is not as recurring
Right.
as you thought, and then it becomes an 18 times earnings
Yes.
stock. And that's what scares us sometimes with some of our investments. Adobe's a perfect example of a stock that we own. It's trading at the same price we bought it at 4 years ago.
Yep.
Even though the earnings have grown.
I think 2 years ago.
Did we buy it 2 years ago?
Yeah.
Well,
Oh, yeah, sure. But the price has been flat.
Yeah, the price has been flat, right? And so if you look at the company, its earnings have grown tremendously, but the worries about the impact of AI and how that's going to play out on its business have kept a lid on its valuation, even though the results have been fine to better than expected.
No, and I think that's kind of exactly the point, where I think Adobe's an example of the opposite of that, where if you just purely look at the financial statements, like revenues and incomes and operating profit continually grow up 10%, 11% every quarter, year to year.
Yeah.
But then, and it looks like a super smooth recurring revenue business. But then there's this big overhang over the business about whether AI is going to end up disrupting the need for their software. So it's not easy.
It's not easy. It's not easy. And sometimes you will reject a company because it's trading at a high valuation, and then it trades at an even higher valuation, right? I remember people saying, well, I'm not going to buy Costco at 35 times earnings.
Right.
It should trade at 20 times earnings like a grocery store, and now it's at 50 times earnings. So it's not easy predicting the future, but we will do our best. But talking about the past, the first 6 months of the year, I think we've kind of set the table in terms of the performance. Some notable winners in our portfolio, Ernest, you've highlighted Netflix, the TMX Group, and Topicus, the spinoff from Constellation Software, as strong performers for the first 6 months of the year. Quickly talk about those three names and what went right for them, if anything, or it's just steady as usual type business performance, and the market just decided that their earnings are worth more.
Well, I don't think you want to necessarily draw too many conclusions from 6 months of performance.
Fair enough.
Or even 1 year of stock market performance. But I do think that these are three names that are trending in the right direction. And Netflix, we've talked about like many times on this podcast about all the different things that they're doing and the amount of money that they're actually making now versus what they used to do. TMX Group's interesting because they actually benefited from the volatility that we saw in April, because TMX has a large derivatives trading business where they operate the Montreal Exchange. where you can buy and sell like stock options and like Government of Canada bond futures. And demand for this kind of stuff really took off during the volatility in April as people were trying to hedge their exposures to like the Canadian dollar and all those kinds of and the stock market volatility. So they benefited from that.
No, TMX Group, stock is up 31% year to date, but it's not like earnings are growing 30%, right? It's maybe a little bit partially multiple expansion or people recognizing the quality of the business.
Well, and this is one of those things where I don't think anybody's expecting the volatility that we saw in April to continue. And if you talk to the management of TMX, even they would tell you this is not recurring revenue that you should expect quarter after quarter. But part of it is that, and we saw this with the company that we're going to talk about later as well, is that as a business, you want to have set up yourself in a way that you're capturing those opportunities as they come.
You're also seeing strong performance overall in the Canadian financial services sector year to date, right? So the insurance companies have done well. The banks, one of them we'll talk about, is at an all-time high, right? So rising tide lifts all boats sometimes if they're part of a sector that's doing well.
And then I guess one last point on TMX is that the fact that there was so much investor interest in equity options and derivatives was because they did a good job of adding these products and making them available to investors in the first place. So that when the volatility actually happened, the products were there for people to invest in. And so I wouldn't say it's purely luck on the sense of TMX Group. It was also the fact that they did a good job.
Right place, right time, but also smart management and capital allocation.
Right.
And Topicus Group, I think we mentioned this on the podcast before, year to date, it's already deployed more capital in 2025 than it's deployed in its entire life, I think, right? So it's it's been a very, very busy year for Topicus.
Right. So last year, I don't know if you remember, but they paid a dividend.
I remember, yeah.
And then everyone was kind of scared that that was a signal that they didn't have enough companies to acquire. But then you fast forward to this year, where it's been a record level of capital deployment, and they went out and bought the Constellation software of Poland as well. So a lot of good things that they're doing.
Very nice. On the flip side, of course, we are not perfect, unfortunately, Ernest. Maybe next year we'll get it perfect. We've had 3 or 4 names that are not worked out well at all. TFI International down over 30% year to date. Apple, which is shocking to me, down to over 20%. And Copart. This Copart is for those that remember, we've talked about this on the podcast before. Copart is involved in auto auctions, and it's really the dominant player combined with IAA that is now owned by Ritchie Brothers. Fantastic business, but the growth is maybe slowing a bit, and the market's concerned about maybe it losing some contracts. So why don't we just quickly talk about the horrible performance year to date of TFI, Apple, and Copart, and is there any hope for rebounding?
Could you make a time machine, go back and sell those 3 and buy the first 3?
No, well, you know as well as I do that generally, if it's a good business, the names that underperform in 1 year or 2 years tend to be the outperformers going forward.
So this is not really answering your question, but I find that a lot of people throw around phrases like, water your flowers and cut your weeds, and these kind of generalized investing like talking points.
Yeah.
And I don't find them to be that useful because I think, as you pointed out a little earlier, there's no rule you can kind of reliably follow for stocks that predicts future outcomes, right? Like sometimes there might be if you look at the post-COVID period, there were a lot of COVID winners like Zoom that fell and never came back.
Yeah.
Whereas Netflix fell and then came back, right?
Correct.
So it's all very specific to the situation. Like sometimes there might be businesses that are not doing well, and it makes sense for you to sell the stock. Other times, maybe you should buy more because the market's overreacting to a temporary situation that the management might be fixing.
And sometimes just the price of the stock is down because of the cyclicality in the business or the seasonality, and rightly so. The results stink right now. Who knows when the cycle is going to turn? I don't need to own this stock, but in TFI's case, for example, it could be all just cyclicality. Of course, the tariffs don't help, and the uncertainty with those kind of issues hurt the stock. But I don't feel that Apple or Copart have become worse businesses, although everybody seems to hate Apple on FinTwit nonstop. Apple, I think there was a lot of expectation this year that Apple would be a leader in AI with the brand new phones and the iPhone 16, and that would lead to more conversions to upgrade your phone from 14 or 15 or to whatever to the 16 as it added more AI features. But the AI features seem to be irrelevant at the moment.
Right. They launched Apple Intelligence and it's been bad.
Yeah, really bad.
The timeline to implementing to fixing it is slower than people expected, and I think last night they just lost their top AI guy to Facebook.
Maybe that's a good thing.
So, I think Apple will be all right because if you take a step back and look at what Apple has going for it, is that they have number one, they have the best products. Like no one is disputing that the iPhone and the Mac are the best products that you can buy in that category, right?
I mean, I'm not going to get into a fight with an Android user, but they may say that they have the better products or the more there's more innovations in some of the products. But certainly, Apple's done a wonderful job keeping you enclosed in their system.
No, I'm an Android user myself, and I don't think it's a good product.
There you go.
Right. So we could talk a lot about this in the future, but so that's the first thing for Apple. I think the second thing that they have going for them, I think, which is especially important in an AI world, is that they have access to all the data that's on your phone. So whether it be your emails, like whether it be your photos, whether, even the guts that are kind of controlling all the apps in there.
Well, for sure.
Apple is the only one that has the ability to access that personal information, which is kind of due to their focus on privacy that the users trust.
Yeah.
And so to me, it's just more of a timing issue of when Apple will be able to figure it out, as opposed to Apple getting disrupted by somebody else.
I mean, I just put it simply, if you're going to do AI, chances are it's going to be done on an Apple product in the future. You just have to be patient and wait for things to play out. But we're hopeful that over the long term, Apple will sell more products and services to users at higher prices and still be the dominant, at least a dominant part of people's lives who like the Apple ecosystem.
Right.
Yeah.
Okay.
I just ordered new AirPods today because my wife has been using mine and we can't find mine anymore, and so new AirPods are on the way, and just like that, right? And eventually, I think I have an iPhone 14. I'll probably get an iPhone 17 in September of 2025. Right? Is there a new phone coming out? Yeah, every September.
Every year. Yep, September.
Yeah.
And then Copart, don't want to get too deep in the weeds on this one, but the revenue growth has slowed a little bit, but I think they've gone through these blips in the past, and I think that they have these are things that generally resolve themselves over time.
I think that's the case, and in fact, Copart continues to build out its competitive advantage by acquiring more land for its storage or tow yards, as well as getting into other interesting parts of the business, even involved in auctions of non-cars, and just a beautiful balance sheet, Ernest.
Yep.
Tremendous amount of cash there. What is it, over 10% of the market cap now? That's not such a bad place to be, especially if it's looking to continue to grow its business.
Yeah, I think the main issue for Copart was that some of the carriers that they focused, that they were partnering with, has been losing share to carriers that were more aligned with IAA. I don't really view that as more of anything more than like a short-term thing that may or may not turn itself around in the next little while. But I think things are still doing pretty well. Like revenue was still up 10% last quarter.
Nothing wrong with that.
So
if in a world where GDP grows 1 to 2%,
exactly.
you got a business growing 9 to 10%. You got double-digit earnings growth. You have billions in cash waiting to be deployed. You have continue to grow your competitive advantage by owning significant tracts of land in all the best places. It makes you very appealing to your customers, which are the insurance companies. So we'll I guess in 6 months we'll see if the loser three are become the winner three, and the winner three become the loser three. Chances are I would put my money on the loser three doing better than the winner three the next 6 months. But that's just the way it goes. We don't sell companies because the share price wilters or falters. We sell because we found a better investment idea. Right? Sometimes the market will be ahead of us and recognize that the business maybe has been disrupted, maybe the business growth is slowing, and sometimes we'll be late to sell a stock. Sometimes we'll be early. Hard to know. But no one's ever going to be able to buy a stock at the bottom and sell it at the top. Impossible. So don't even think about that. Just think about over the long term how your portfolio is doing, and is it growing, and is it growing in a nice risk-adjusted way.
But one thing that is interesting, I don't know if I know we're getting a little long on this discussion, but one thing about the top three names is that those are all businesses that are doing really well.
Yes.
Right? Like there's nothing that's going poorly for those businesses today.
Correct.
Either from a cyclicality perspective or from a competitive perspective.
But anything can happen.
Anything can happen.
Yeah.
Whereas if you look at the ones that are underperforming, like revenue growth is maybe not what it used to be. There's maybe some lingering questions about the business, right? Like, so I think the analytical aspect is maybe a little bit different for those names versus.
For sure. Yeah. Then it's hard to reconcile with an Adobe, which is down 15% year to date, where year to date it's already beaten its expectations, raised its guidance, and saying its business is doing well, and knowing like they're not seeing any impact from AI, people not using Adobe products instead of using these made-up AI stuff to do editing and creation tools, and you haven't seen anything of it. So sometimes stocks go down, sectors go down. There's no rhyme or reason to it. Sometimes there is a good reason. There's good reason for the three stocks, TFI, Apple, and Copart, to be down. But it's weird, right? Sometimes the market will get excited about some narrative or theme or future projections or potential and start applying high multiples, right? How do you explain how Tesla is trading at 100 times earnings, right? When the current deliveries of the cars are not very good in a lot of countries. So it's very hard. And we've said that before. Investing is very, very hard. But talking about a long-term investment, and this is what the podcast is all about, National Bank of Canada is one that we've owned in the portfolio for 20 plus years. We bought it well before Ernest started working here at Baskin.
Yep.
Probably bought it when Ernest was in high school. And it's a company that initially, Ernest, we bought it because we thought it was attractively valued compared to the other Canadian banks. At the time, I think it wasn't the greatest thesis in the world, but it traded at a meaningful discount to the other Canadian banks because of, I guess you can call it the Quebec discount, the fact that most of its assets and revenues were situated in Quebec. No question, in 2004, National Bank was a much different bank than it is today. When we bought it in 2004, it was probably very much focused on proprietary financial trading as well as regular banking in Quebec. Now it's morphed into a custody business, proprietary trading, as well as assets in Cambodia, credit strategies in the United States, and the big acquisition that it just made or closed a few weeks ago of a Canadian Western Bank. So it was very interesting when we bought the stock. It traded at the Quebec discount. Then for a long time, it traded at a premium.
Yep.
It traded at a premium to all other Canadian banks. One of the things that attracted us to National Bank was just the excellent operations in its finance and trading and wealth divisions. And over the last few years, the analysts would always say, well, that's it's a more cyclical business, not as recurring, but through great management, through great skill, capital allocation, acquisitions, what have they done? National Bank has really been one of the top performers. Over the last 20 years, going back to 2004, it's outperformed Royal Bank.
Yep.
Royal Bank's done fine, I think. So compound returns, if you've held it for the last 20 years, is just over 10% a year. If you reinvested those dividends, you would have gotten 13% a year. You're not gonna kick that stock out of the house for that type of performance.
Yeah, I think National Bank is one of those companies that it's pretty hard to evaluate the company and kind of the positions that they have without having followed the business for a long time. Because imagine if you were starting research on National Bank today and you flip open the investor deck and they're operating in Quebec, they operate in Cambodia, they own this little specialty finance thing in the US, and it's sort of this mishmash of weird stuff that that doesn't really have much rhyme or reason to go together with it. But then you look at the performance and it's outperformed every other Canadian bank over like any period of time.
One of the attractions of National Bank was the CEO Louis Vachon.
Yep.
Is that his name? Louis, yeah. So and I think he was one of the longest tenured Canadian bank CEOs in his era.
Yep.
I think he was at National Bank for well over 10 years as CEO, which is, most Canadian banks, the CEOs tend to stick around for 5 to 7 years. So he was at the helm, I think, for 14 years, which is a long tenure and strong performance. He wrote a book, which you bought, and you had to translate it into English because it was written in French. It was a dry read, to say the least.
I thought it was pretty good.
Okay, I tried. The translation left something to be desired.
Probably.
Yeah. But, there were some interesting takeaways, of course, from that book. So, at one point, we called him like Canada's Jamie Dimon. And it's not like there wasn't adversity that National Bank suffered over the last 20 years. It was the great financial crisis. They had issues with asset-backed commercial paper.
Yeah.
They've had the worries about the Canadian economy and interest rates going up in 2022. But it's navigated it very, very well, and like all banks, it's been very acquisitive. The recent acquisition of Canadian Western Bank really transforms it into a much bigger bank, although more commercial banking than maybe residential on that side. And so we're going to do a breakdown of National Bank, and Ernest, kick it off.
So banking is a tough business, right? Where the margins that the banks earn in the spread between what they're lending out mortgages or credit cards at versus what they're paying on their deposits is very, very narrow.
Why is it narrow? They pay me nothing on my cash balances.
Yeah, it's narrow, and I think there's a kind of a broad misunderstanding in society about how banks work, but it's a fairly competitive system.
For sure.
Where if you're shopping for a mortgage today or even a credit card, you're going on Google or Rate Hub and kind of searching on the best offers that exist for the mortgage.
Yeah, for sure.
Or
using
shopping around.
Using a broker.
Yeah. So no bank really has pricing power in the sense that you're able to get more money out of a loan or than anybody else.
Some banks try to pretend that they have some competitive advantage by maybe having longer hours or we're open on Saturday.
And that's the point about the thin margins is that very, very small things matter in banking. So, for example, like having nicer branches that make people want to go in and interact with the agents, or having an app that works better, that can cross-sell customers from their checking account to a credit card.
Correct.
Like whether how disciplined they are in operating their cost base, because like all of those things matter a lot for the returns that a bank earns. And it's very different from kind of the Silicon Valley, like Mark Zuckerberg, move fast and break things model. Because in banking, if you screw up, then you're actually dead.
Yeah.
As we've seen plenty of times in financial history. So what I like about National Bank is that it's exactly what you want to see in a bank. They understand who they are. They understand what their capabilities are to take risk. They understand what they're not and where they don't have a right to make money. And they focus on the areas that they can win. So for most of National's history, that was in Quebec. The way National was created was in 1979 when the two major banks in Quebec merged together to form National Bank. And for those of people who are not Canadians, like Quebec is a different place in Canada versus the rest of the country.
For sure.
They speak French.
Yes, yep. Especially outside Montreal. Yeah.
They largely speak French. They're a little bit more, I would say, nationalistic about their sense of identity as Quebecers. And there's a lot of pride that they have in their culture that as Quebecers. So that's why National and Desjardins, which we share a building with, they kind of dominate the Quebec the banking landscape.
For sure.
Those are the two players that have the largest market share. Other banks are there, but not really.
Bank of Montreal, BMO.
Oh yeah. Oh, Bank of Montreal, Montreal as well.
Yeah.
But like the other banks are there, but not really at the same scale that that the main players have there. And without the relationship, the government and the business community relationships that these companies have.
Yeah. So it's a long tenured history in Quebec, understands the culture.
Yeah.
Many years of working with Quebecers and, strong underwriting results. Quebec itself as an economy has been much different than other Canadian provinces as well. Tended not to get so overvalued, maybe pockets in Montreal in terms of the housing market.
Yeah.
People tended to be better paying their mortgages and their credit cards. Just whether it's the idiosyncratic nature of the culture or, who knows?
Yeah. I don't really know why that is.
Yeah.
But just for whatever reason, the downside scenarios in Quebec seem to be a little lower than the rest of Canada.
So that was the antithesis about National Bank, right? So Quebec-based, what happens if, for those who don't follow Canadian politics, Quebec has threatened to secede from Canada a number of times. And, so there was always, what happens if Quebec leaves Canada? Where does that leave National Bank? How does that play out, right? And so I don't think that's on the table right now, but that's always, in the back of your mind. They've built out their business by doing baby steps, what I would call, right?
Yes.
It's just getting used to a new line of business, not throwing tons and tons of money at it, understanding and then building out from there. The examples are quite clear. Buying the TD Waterhouse institutional business, which is, we work with National Bank here at Baskin because they bought the custody business. They've done a great job, and now they're the market leader in offering products to introducing brokers and wealth management firms. Getting into Credigy, buying small positions, getting the Cambodia, buying small positions. Anyway, I cut you off. You continue.
No, but I think that's exactly the key, which is that I think National understands what it is that it's the term that they use is super regional bank. Like they have a competitive advantage in Quebec, but they don't really have a presence in the rest of Canada. Like they don't have a branch footprint in Toronto or Vancouver.
No, they have a few branches in Toronto and that's it. Really, a handful of branches here and there in other provinces.
And so when Louis Vuitton tried to grow the business, he looked at National and he said, well, like, we can build branches in Toronto and Vancouver, but what are we really doing differently than anybody else who's already doing that, like TD or Royal or CIBC? We could go to the US, but there's like 4,000 banks in the US. So like, what would we be offering that nobody else could?
Very, very
We
interesting.
could go to Europe, but rates are negative. Well, at that time, they were negative in Europe, and regulation was very strong. So,
And, you know, you look at the history of Canadian banks building their businesses outside Canada, it's mixed results.
right.
Scotiabank tried the Latin America route, Caribbean route. Some of it worked, some of it blew up horribly. You know, when some of the TD had its problems in the United States. Other Canadian banks have not done well making acquisitions in the United States. Just because it's a big market,
Right.
and lots of fragmentation, it doesn't mean that you can still make money there, right? You have to. There's so much specialized knowledge that you have to understand and get when running a bank.
No, and I think even if you look at like TD and Royal, which are kind of the best in class Canadian banks, like their returns on equity in the US are lower than what they earn in Canada, which kind of speaks to the competitiveness of the market.
Okay. So where is National Bank today? Why don't you break down its components?
So kind of back to the original point was that National, what they did was, as a result of this process, they decided that they're going to expand into places where nobody else was competing. And so what this ended up looking like was they bought a company called Credigy in the US, which was a specialized lender for non-performing loans. So not really a bank in a traditional sense, but they would provide asset-based lending to companies that are in trouble. They might buy them at a discount and hope to recover some of the money.
Yeah, it's risky, but they a chance for much higher returns.
Yep.
And they haven't bet the bank on it. If they have one or two bad quarters or it blows up, it won't be material.
And then they went to some emerging markets, and I mean emerging markets in like really out there places. So they went to Kazakhstan, they went to Ivory Coast and Mauritius in Africa. They went to Cambodia. And these were, and I think the thesis here was not that they particularly liked these countries, but that these were kind of frontier markets where the population was significantly underbanked, where they had a local operator that they felt like they could trust. And so and more importantly, these were, from the way that the Louis Vuitton described it, these were small investments. They weren't risking the entire bank's capital, but they were high upside, low downside bets that they could make at cheap prices because no one else was looking in these places. And so I would say all of them have worked out all right.
Yeah, I think the Cambodia investment, they've only put in a few $100 million, and probably that portion is worth a few billion. So,
and then Cambodia has worked out spectacularly well.
Yeah.
So we're to a point where today it's like a fairly meaningful portion of their profits, which, like, you know, that I think that leads to some other questions that analysts now have about the exposure that they have in Cambodia.
Right. That's right. It's a turn, and when you speak to other investors, it's an immediate turnoff. Why do I want that exposure? I don't want that, you know, without even recognizing that it could be an excellent part of its business, right? Or generating very, very strong results, which has been the case. But then you see news headlines where Trump says on August 1st, Cambodia tariffs are going to 35%. That is not so good.
No, but I think the lesson here is not that you particularly have conviction in the growth of Cambodia, but that the management has done an outstanding job of finding these little pockets of inefficiency where they can earn good returns. And I think the stock price and the returns on equity that National Bank has over time has proven that, where they have the highest return on equity in the Canadian banking industry, and they have and the stock price has performed the best.
Yeah, they're not afraid to become operators and get their hands dirty. So the acquisition, $5 billion acquisition of Canadian Western Bank. Canadian Western Bank's stock, I think it did nothing for 10 years.
No, and
Yeah,
again,
yeah,
same thing for
yeah,
Canadian Western Bank.
yeah. Low valuation. Nobody wanted it.
Yep. Similar situation where
Yeah.
they were looking for opportunities to grow. They thought that Canada had some good things going for it going forward, especially Canadian Western Bank, which had been struggling for a variety of issues. Then they acquired it using a portion of their own stock, which was a little more premium valued at the time as well.
Although the stock is now higher than when they did the
Yes.
offering. Yes.
And then there's a Canadian Western Bank is commercial small business loans in Alberta, in a place where they don't have to have a large footprint, where National doesn't have to go out and build a footprint to gain scale.
Well, one of the interesting things about Canadian Western Bank is they actually own a number of wealth management firms. And so there's some cross-selling opportunity under the ownership of Canadian Western Bank. It's probably very hard to offer your clients great banking and insurance and those kind of operations. But now under the National Bank umbrella, it certainly looks more attractive. And we expect wealth management to be a pretty big focus for National Bank going forward as they continue to build out their exposure in Western Canada.
What's interesting, not just for National, but for National, is that like regular banking, like where you deposit money into a checking account and get a mortgage, that's only about a third of its business today in terms of overall earnings contribution to the company. Wealth management, capital markets, and international are together a much larger portion of earnings than regular banking. And over time, companies, the banks that have done a better job at growing these other portions of the business, because they're generally more asset light and maybe a little bit less competitive than consumer banking, generally earn higher valuation multiples than other banks.
Very interesting. So I've spoken to National Bank, executives at high levels before, trying to understand what the strategy is, and it's essentially how we like to invest. We're playing the long game is what the answer is. What they're going to say is, we will make an acquisition, and we will try to understand how to grow using that acquisition as a platform to grow its base. They did that with the wealth management platform of TD Waterhouse Institutional, and now they're the dominant player and continue to add more products and services. So when our clients used to have their money at TD Waterhouse, moved on to National Bank. Now through National, we've offered our clients 2 pooled funds, right? So there's just more things that they can offer to their customers as they build out the wealth management platforms. And I expect that they'll use the same playbook with the Canadian Western Bank, is try to build out their banking services into the Alberta, which and as well as BC, which could be faster growing markets than maybe Quebec. So what else do you want to say about National Bank?
Well, it's a really unique bank, right? Like, I think if you look at the other big banks, they kind of are everyone to everyone, everything to everyone. They have large footprints in Canada and the US, maybe some in like Latin America, like Scotiabank. And it's not like they have big brands and big scale, but it's not really clear that all the stuff that they're doing is necessarily value creating for shareholders. Whereas in National Bank, they know what they are. And they are so disciplined in what they're doing that makes me very comfortable owning it for the long run.
And any comments on the new president, Laurent? Have you read anything about him in terms of his capital allocation skills? Or
no, I think one of the things that's interesting about National is that a lot of their executives kind of came through more working class backgrounds. I don't know if that stuff matters that much in the end, but like they do look for people that
started.
Maybe it's partly because they're from Quebec as well. They only want people who really understand the culture of of being a Quebec-based bank.
Makes
So
sense.
I don't expect that. Well, we haven't seen much, and don't expect any meaningful changes in the strategy going forward.
All right, and it's a great overview of National Bank. Anything about the Canadian banking sector that has caught your eye, the highs or the lows in terms of what's going on?
Well, I think without making comments on individual banks, I think that lower interest rates have really helped in the sense that if we look back a year or two, the big fear was that the mortgage wave renewal was going to crush the economy.
Totally.
And I was worried about that as
We were
well.
all worried. We saw lots of charts where if mortgages stay at 6 or 7%, it's going to be really, really bad as things start to roll over in 2025 and 2026.
Yeah.
Now mortgage rates have come down. I think you can get a 5-year mortgage for 4% and change in Canada. You can get a floating rate with potential of more rate cuts to come. So it's not like the housing market is doing incredible, but certainly it would have been calamitous had rates not come down.
I think those that have a good retail footprint, like they do a good job in managing the customer experience. And I think everybody who follows Canadian banks knows which ones those are.
Yeah.
Like they are benefiting from this situation because on the funding side, depositors are less buying GICs because rates have come down and more migrating to savings and checkings accounts because not really getting the yield anymore. And so even as mortgage rates have come down, the net interest margins that they're earning has been protected.
Good. And what about disruption in banks? We hear a lot about Wealthsimple
Yep.
trying to get into banking. We saw a deal the other day where the Wealth One Bank, they're trying to make this into an online bank. You've got EQ Bank that's all online as well.
Yep.
My mother wants to go in and with her bank book and have everything stamped and checked. She's never going to do banking online, but the younger generation doesn't want to go into a bank and doesn't want to talk to people. And
Right.
so
Every time you go into a bank, you see like the old guy with like the book that's standing there for like an hour.
I think but I think some banks no longer accept the bank books anymore. I don't know. I haven't been in a bank in forever. I just go to the ATM machine. My dog goes into the bank more than I do because it's a lot of treats when my wife goes.
Dog treats.
Yeah, dog treats. TD Banks just walk. That's part of their walk almost every day. Is they go into the bank and see their friends at the bank and get a.
Are they doing banking there, or are they just eating dog treats?
Well, once in a while, my wife's getting some cash, maybe, but mostly dog treats.
Okay.
So, TD Bank, thank you very much for making my dog fat. So, but what I was going to ask is, so we've got over that hump of really worries about the larger potential for mortgage rate or even a crisis there. The Canadian economy, not so hot, not so cold, but any innovations in banking that the Canadian banks should be worried about in terms of these online banks?
Well, I think Wealthsimple, I think what you notice has been getting a bit of press lately because they did a big flashy presentation on how they were disrupting the big banks. I'm a little skeptical that these kind of things generally end up being meaningful disruptors.
Yeah.
Because I think if you look at the things that they like that Wealthsimple was saying, like a lot of those things maybe resonate for the customer base that Wealthsimple has, which is kind of the younger, tech savvy, but not super wealthy.
No.
Like Gen Z.
Did you hear one of the things they propose is to deliver cash to your house or your
Right. Right.
using Uber Eats or whatever? I don't know.
And so like when they proposed a credit card that didn't have maybe some of the constraints that the credit cards from the big banks are offering, and then you read the fine print, and then you have to have like $100,000 at Wealthsimple to qualify for some of the terms for no fees. So
Wealthsimple is not in the non-for-profit business, so read the fine print on whatever you buy from them.
Yeah. So I think this really speaks to I think one of the things that's maybe a little misunderstood about the big Canadian banks is that they want to focus on, like everybody else, like Ferrari, right? Like they want to focus on the high end, where on people that have money, that are not, that have stable jobs, that like have a lot of collateral in their house. And so if you look at their mortgage books, like they're all extremely well protected mortgage properties. They're not lending to, like the unemployed guy who is driving Uber, right?
Correct.
These are, and they're not lending to investors taking out a fourth mortgage to buy like investment condos.
They were dealing with higher end clients.
These are high end clients and that have a lot of money, that value the service that they're providing. And so it's very hard for somebody like Wealthsimple to be able to offer the same level of sophistication to these clients. And I actually think the Canadian banks would be happy if Wealthsimple took the lower end customers that are very costly to serve, but don't really generate a lot of revenues necessarily.
Yeah. The issue is one day the low end customer can become a high end customer, right? The young working professional or family can then inherit a lot of money or make a lot of money. Then you maybe have missed out, or maybe that's a natural transition where they say, I need better advice. I need better services. I can't deal with this online stuff. I need to speak to someone. I need recommendations, and then they move on to a higher end bank. Hard to know. The final thing I want to get to about banking is a lot of investors will say, we don't buy banks, right? It's lots of leverage business. You have no control over a lot of things. It's very competitive. You can't, as you said, it's hard to differentiate yourself. There's been spectacular blowups, like financial crisis, right? With Citigroup and Wells Fargo. And then, of course, there's been fabulous successes like the Canadian banks over the years. JP Morgan has done incredible. And some of the investment banks, of course, not really banks, but they've also done really, really well. So, a guy like Terry Smith, who runs FundSmith, to say, I never buy airlines. I never buy this. I never buy that. And to some degree, he's right. But there's always outliers in any industry that maybe are smarter about allocating capital. And so you really should never say no in terms of any business line, right?
Yeah, so that's one of the things that is goes back to the original point we were making about not using heuristics or shortcuts to picking stocks, because I think as a general rule, saying that I'm going to avoid financials because they're commodity businesses with no meaningful pricing power, and then only focusing on businesses that are asset light and have recurring revenues and pricing power and so on, like that probably works pretty well in the long term. I think that's perfectly fine to say, but then you might also miss out on opportunities like National Bank that have done pretty well.
Got to keep an open mind in investing for sure. That's what I've learned, and some of the mistakes I've made is when I've kept a closed mind or being extremely dogmatic about how I was going to invest. So still learning, still growing. And with that, thank you so much for joining us, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer, or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.